Hey guys, welcome back to Father and Son Investing. We're going to talk today about a dirty deed that Vanguard did to some of their customers recently. I generally really like Vanguard. I actually hold my brokerage account and one of my IRAs there at Vanguard. But they did something recently to the small investor that Jack Bogle would just turn over in his grave if he were to hear about it. Let's talk about what they did. In order to do that, we'll talk about these areas. First, we'll talk about just quickly how Vanguard came about and who is Jack Bogle. We're going to talk about an article that appeared in the Wall Street Journal recently, talking about this dirty deed that Vanguard did to their customers, throwing them under the bus. We're going to talk briefly about mutual funds, just highlighting the particular importance of one area of a mutual fund that relates to this deed that Vanguard did. And then we're going to get down to the target date funds. That's where Vanguard really disappointed all of the individual investors at the expense of their institutional investors. Let's talk about that. So just a brief introduction to Jack Bogle and Vanguard. Mr. Bogle was an executive at Wellington Management Company. That was an investment management firm. In the 1970s, he created Vanguard in order to manage Wellington's funds, but then he also created the Vanguard Group of investment companies, and he termed it the Vanguard Experiment. The intent was that these mutual funds would manage these funds at cost and independently with their own directors, officers, and staff. Now, this was a very new way of doing business when it came to mutual funds and asset management. Mr. Bogle is commonly known as the founder of index funds, which initially were not that popular. In fact, the experiment of it was kind of looked at as a failure as well as anti-American. Now, essentially, Vanguard and Mr. Bogle were known as maintaining investment costs really among the lowest in the industry, and they have been a big driver in helping or causing other companies to drive down their costs in order to compete with Vanguard. That was a very great thing that Mr. Bogle and Vanguard did for the individual investor. Now let's just turn to this article that appeared earlier this month in the Wall Street Journal. The headline reads, "The huge tax bills that came out of nowhere at Vanguard." What is it that Vanguard did that created these huge tax bills for individual investors? Well, in order to understand this, I need to give you a little bit of background first about how mutual fund shares are created, how they are bought and sold. So when an individual investor decides to trade his cash for shares of a mutual fund, the mutual fund then has to go and take his cash out to the stock market, purchase shares of all the stocks that make up their mutual fund, bring that back into the mutual fund, and then they issue that individual investor a share of the mutual fund. The opposite holds true. When that individual investor wants to redeem a share or sell a share of his mutual fund, he has to let the mutual fund know. They go back out into the stock market and sell those individual shares of each individual company in order to get the cash to pay back the investor. That is vastly different than the way that exchange-traded funds work. I'm not going to cover that here, but I did a video about that earlier, and I will put a link here at the top. And if you're curious about the differences between exchange-traded funds and mutual funds, you can click on that video. Now, the other thing that I want to cover before we hit that Wall Street Journal article is going to be that there can be different types of shares of a mutual fund. So before you, I have two different types of shares that I own in two different accounts. To the right is the type that I have within my 401k. To the left is the type that I have within my Roth IRA. If we look at these, we'll see that the title of them looks very similar. Vanguard Target Retirement Fund 2040. And on the right here, Vanguard Institutional Target Retirement 2040 Fund. What's the difference? The difference is that one of them is institutional shares. Now, why are there institutional shares? Well, in general, when there is a lot of money to be invested in a Vanguard account, such as happens in 401ks or other retirement funds, then Vanguard tries to get these large sums of money interested in investing by bringing down the cost just a little bit. So we'll look quickly here. We'll see that the net expense ratio for the institutional shares is 0.09%. If we turn our attention to the regular retirement fund, we'll see that their fee is 0.14%. So you're going to save 0.05% if you are getting this through an institutional retirement fund. Now, why is that important? Well, let's go back in time to 2020. In 2020, Vanguard reduced the minimum investment in its institutional target retirement funds to only $5 million from $100 million. What the minimum investment means is that in order to qualify for the institutional shares, there has to be at least $100 million to invest. At least that's what it used to be. It went from $100 million all the way down to only $5 million. Now, $5 million sounds like a lot, but when you start pooling the funds of a lot of people in a retirement fund, $5 million isn't all that much. Well, what would you do if you could reduce your fees by 0.05% simply by changing from the regular target date retirement fund to the institutional share retirement fund? Obviously, you're going to sell your shares within that regular fund and move on over to the institutional fund. Let's go back to our little graphic here quickly then. So somebody is going to sell shares back to the mutual fund in order to be able to purchase shares within the other fund. For that to happen, the mutual fund is going to go back out to the stock market, sell the individual stocks that make up the fund in order to get the cash to return to the investor that they then will use to buy the institutional shares. What does that do in terms of taxes? Well, every time one of these stocks gets sold, if it gets sold for more than it was purchased for, it creates a capital gain. Even if you're not the one selling your shares, when somebody else within the fund sells their shares, it creates a capital gain for everybody who is still holding shares in the fund. Let's go back to the Wall Street Journal article. It says here, last year assets at Vanguard's 2035 target fund shrank to $38 billion from $46 billion at year-end 2020. The 2040 fund shriveled to $29 billion from $36 billion. So we can see that they sold off quite a number of shares. Well, the Wall Street Journal goes on to report that Vanguard's target retirement fund for 2035 and 2040 distributed approximately 15% of their total assets as capital gains, which are taxable outside of retirement accounts. The article goes on to describe an investor known on a Reddit board as Sitting Hawk, who said that he'd received $550,000 in distributions from Vanguard for his 2035 fund. So, because of that, he owes 23.8% in federal tax and an additional almost 5% in Illinois state tax on this distribution that he received from Vanguard. What does that tax bill add up to for him? More than $150K. Looking back at the title for this article, we'll see that the subtitle says, "A change that benefited big clients and left little ones holding the bag," in this case, a big tax bag to Uncle Sam. Now, this has not gone unnoticed by government. At least in the state of Massachusetts, we see another article here in the Wall Street Journal where the headline reads, "Massachusetts investigates potential target date funds tax issue." The Secretary of the Commonwealth has sent letters to 5 asset management companies, including Vanguard, regarding their notification of individual investors and the tax issue that can develop. It says here that the Secretary of the Commonwealth is particularly concerned by reports of inadequately disclosed fund changes that shifted financial burdens to small dollar investors, resulting in large tax bills for those who held the funds in non-retirement accounts. In another article, we see that Mr. Galvin, the Secretary of the Commonwealth, had this to say: "Financial institutions can't be permitted to protect one class of investors at the expense of another. Investors need to be made aware of the risks involved and the tax liabilities they could face in certain circumstances, and I want to make sure institutions are being upfront about these risks." And in yet another article at Think Advisor by Melody Waddell, we see just exactly what it is that Mr. Galvin is wanting a response from these 5 institutions. If you're interested in them, you can pause the video here and go ahead and read them. Just know that he expects these answers in writing by February 9th. So what should the take-home message be for today's video? Well, number 1, certain types of funds just should not be held in taxable accounts. In fact, in the Wall Street Journal article, a spokeswoman from Vanguard said that because the target retirement approach seeks to reduce risk over time by automatically trimming stock positions, quote, these funds are best served in a tax-deferred account. And also in the second Wall Street Journal article, it states here, target date funds are tailored for investors in 401k or other retirement plans where taxes are deferred. They aren't managed to minimize dividends or capital gains. If they are held in a taxable account instead of a retirement plan, the holder will owe taxes on those payouts, amounts that sometimes could be greater than in other types of funds. What's another take-home message from today's video? Well, even though Vanguard is actually very good for individual investors, occasionally they're not. Now, whose fault is that? I don't know that it's totally Vanguard's, but there are some things that Vanguard could do to help minimize this type of occurrence happening to individual investors in the future. In the Wall Street Journal article, it says here, yet nowhere on the fund's main pages, Vanguard.com, does the firm tell investors that the funds aren't ideal for taxable accounts. The summary prospectus, a document no one reads, intones on page blah, 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 distributions may be taxable as ordinary income or capital gain. Now, I know that when I have been buying shares of stocks in my IRA account on Vanguard, at least one type of share has clicked up a notice for me when I've gone to click on it, and that's been a limited partnership. And it will state before you buy the shares that this might not be a great thing to hold within an IRA. Vanguard could do something similar for people who are purchasing shares within a taxable account when it comes to target date retirement funds. Just a simple pop-up that says this might not be ideal and why, because you might be paying taxes that you're not anticipating. Even if you're not the one selling your shares, when somebody else within the fund sells their shares, it creates a capital gain for everybody who is still holding shares in the fund. All right, I hope this was interesting for you. It's a little different than me just talking about stocks. Although I like talking about individual stocks, I'm very interested in helping people, especially young people, to increase their knowledge regarding investments, including mutual funds. I don't own a lot of mutual funds, but I do have at least 4, all on Vanguard, all in an IRA. If this was helpful for you, please give us a thumbs up. We need that for the YouTube algorithm. We'd love to have you as a subscriber. Share this information with a young person in your life. Don't let them make the same mistake that this poor guy who got the $150,000 tax bill made. And as always, until next time, enjoy your investing.